Hey guys, welcome back to another free alpha video. Today we're going to talk about Aries, leverage, and if you need it to outperform the S&P 500. If you're new, buckle up and pay attention. For those that don't know, Aries is our trading model built from our economic regime system and our market trend pricing algorithm. Aries uses 3x leveraged products to capture major moves across equities and bonds throughout bullish and bearish markets by only longing either TQQQ, which is the 3x leveraged NASDAQ, or TMF, which is 3x leveraged long bonds. Forward testing since 2005, it has returned a compounded annual growth rate, or CAGR, of over 30%, turning every $100 into over 12 grand. Now, some of you might be wondering, what is the trade-off? There has to be a drawdown to such stellar returns. The biggest trade-off is going to be portfolio volatility, and that is why we're making this video today. Let's start off with the screen here. You can see Aries leveraged in red and SPY in blue. Both of these are indexed to 100 and show the end result for every $100 invested since 2005. As you can see, SPY is only up 5 times where you invested, and there are many choppy drawdowns along the way. Whereas if we look at Aries, we can see some really crazy returns. Primarily, this is going to be due to the leverage and compounding factors over time. Let's go over to the next chart. This again is going to be Aries in red, except this time, instead of using leverage, Aries is only long QQQ and TLT, so it's unleveraged. As you can see, the performance is still superior to SPY. We can see that almost all major drops have been avoided due to the regime signals telling Aries what period to be in and out of bonds or equities. Now, the next chart is going to show you all three. Aries leveraged in red, Aries unleveraged in yellow, and SPY in blue. As you can see, both versions of Aries easily outperform the S&P 500 throughout this period. So you're probably wondering, what do the actual stats of each version of Aries and SPY look like since the start? As you can see here, the total return is ridiculously higher at over 12,000%. The CAGR is 31.8%. The Sharpe ratio is almost 3 times larger than SPY, and the Sortino ratio is almost 4 times higher. Remember, these numbers are high, but they're not the best they could be. A Sharpe ratio, anything between 1 and 2 is considered good. We're there here, right? But a Sortino ratio, anything above 2 is considered good. We're not above 2, and that's going to be due to the reason that the portfolio is very concentrated. It's either along 100% bonds or 100% stocks. And due to this, it's going to have a certain level of drawdown risk and volatility that can't be avoided and will weigh on these numbers. This is where it's interesting though. During 2008, when SPY drew down almost 60%, Aries was able to actually draw down less while running 3 times leverage. But we can pull each other's plugs all day with these numbers. At the end of the day, the top number here is all that matters, 12,000%. All of these stats outperformed SPY during this time period. What's also really interesting is that without leverage, we drew down less than both Aries and SPY. As you can see, you don't always need to use leverage to outperform markets. You just need a model that is robust enough to weather the storms and give high confidence signals to prevent major drawdowns. That's what Aries has done here, both leveraged and unleveraged.